Silicon Valley is basically fighting to the death for GPUs right now, but it turns out the real money is in industrial plumbing and special flooring. Welcome to Earnings Unscripted. It is March 18th, 2026, and today we are unpacking Jabil, ticker JBL, and their Q2-26 numbers. They just posted a quarter that completely redefines what they do. Miro, what stood out?
Yeah, well, the sheer speed of execution here is genuinely staggering. Look, Jabil is the ultimate picks and shovels player, right? They manufacture and assemble the physical architecture for tech giants. And they basically just unblocked the AI supply chain. They retrofitted an entire East Coast facility for heavy liquid cooling about 2 or 3 months ahead of schedule.
2 months early in this capital cycle is basically a lifetime. And actually, real quick, before we tear into the financials, just to remind you that this is purely our personal opinion, definitely not financial advice. But looking at the top line, revenue came in at $8.28 billion, which is, technically flat from last quarter, but it totally blew past their own internal guidance by $500 million.
Right, because the mix is shifting violently under the hood. Their intelligent infrastructure segment, which handles all the AI data center hardware, completely drove that beat. But there is a really weird friction point in the profits. GAAP operating income surged, up 32% sequentially to $374 million. But core operating income, the non-GAAP number they usually want us to look at, actually slipped 4% down to $436 million. So GAAP earnings soared to $2.08 a share, up 54%, while core EPS dropped to $2.69.
Wait, okay, a 32% spike in GAAP, but a drop in core. That is quite the divergence. Is that why the stock had a complete meltdown this morning? Because pre-market, it plunged all the way down near 241 before the bell.
Yeah, the trading algorithms, they definitely panicked read the initial print. But the second the regular session opened, the stock violently reversed. It surged straight back up above the 255 level in the first couple of hours. Basically, once human buyers looked closer and realized Jabil wasn't just building standalone parts anymore, they stabilized it. It still closed at 258.67. That is below yesterday's extended hours, but the intraday recovery was fierce. The market realized they're selling holistic AI systems now, not just basic components.
I actually love that part of the story. The CEO literally mentioned they don't even need complex semiconductor fabs for this massive growth segment. They're just laying down special flooring and racking cooling servers. It is surprisingly asset light for how much cash it prints. All right, let's actually dig into the weeds on how they're pulling this off.
Well, it is asset light on the factory floor, sure. But if you actually look at the balance sheet, they just levered up heavily. Total debt jumped by, almost exactly $1 billion, up to $3.87 billion.
$1 billion in a single quarter? That sounds like a liquidity crisis if you just read the headline.
Right. It is a 34% jump sequentially, but they didn't borrow it to cover a burn rate. They used it to buy time. They literally bought Hanley Energy Group for about $750 million to just skip the line.
Right. Instead of spending, 3 to 5 years trying to figure out data center power architecture organically, they just buy the expertise and bolt it on.
Precisely. And honestly, it is a masterclass in capital allocation because the power market for AI right now, if you wait to build it yourself, you lose. Heberd, the CFO, even hinted they aren't done. He said, quote, "We are at a point in leverage where we could lever up if the right type of M&A deal was available to us."
So they are still hungry. They are basically saying, if we see another missing puzzle piece, we will just buy that too.
Oh, without hesitation. Because having that full stack, the compute integration, the liquid cooling, and now the power arrays, that is what fundamentally changes their pricing leverage.
And it is not just in AI where they're being smart about this. Even in the legacy businesses, they're playing a very defensive game.
You mean the EV slowdown?
Exactly. The whole automotive sector is bracing for impact, right? But Jabil saw the global EV slowdown arriving quarters ago, so they shifted their R&D to focus on compute models that are powertrain-agnostic.
Which is brilliant. So it does not matter if the customer is building internal combustion, hybrid, or full electric, Jabil's platform goes across all of them. Destor specifically noted OEMs want to go across platforms now. It completely insulates their margins even when competitors are taking massive hits.
Right. It all comes back to being indispensable, whether it's a hybrid car or an AI data center. Which actually explains the overall margin shift, doesn't it? Because forever, Jabil was this, tight margin contract manufacturer. It was always a volume game. But now, Destor is saying they aren't even focused on just hitting 6% anymore.
Yeah, he was surprisingly aggressive about that. He said, and this is practically a direct quote, "It is how do we go beyond 6% where the management team is focused on right now."
Going beyond 6% completely changes how Wall Street values them. They are not an assembler anymore. They are a highly specialized engineering service.
And that newfound leverage is already showing up in the pipeline because arguably the most interesting nugget on the whole call for me was a somewhat casual mention of a third hyperscaler.
Oh, yeah, I circled that too. Destor said they are in close discussions with a third major hyperscaler and expect closure within the next few weeks.
Yeah, which sets up a massive fiscal 2027. But it also it explains the weird inventory numbers this quarter.
Wait, what weird numbers?
So gross inventory days spiked to 75.
Okay, that is usually a massive red flag for hardware, like you are sitting on unsold stock.
Exactly. But net of customer deposits, it drops right back down to their 60-day target.
Wow. So the hyperscalers are literally parking cash on Jabil's balance sheet to hold their spot in line.
Yeah, it is entirely de-risked. That inventory isn't a liability, it is a sticky commitment. It's basically a waiting list with a massive cover charge.
That is such a good way to frame it. Okay, so zooming out, where does all of this structural dominance actually leave them heading into the rest of the year?
It leaves them incredibly confident. Look, they just aggressively bumped the full fiscal year revenue projection up to roughly $34 billion. That is a massive $1.6 billion hike from their previous guide.
Wow, okay, you do not just raise by over $1 billion on vibes. That is serious visibility.
Yeah, Destor basically said the intelligent infrastructure segment alone is going to hit $16.5 billion. That is 34% growth over fiscal 2025. And they dragged full-year core EPS up to $12.25. For Q3, they bracketed revenue right between $8.1 and $8.9 billion.
Right. So they are explicitly telling us the AI CapEx cycle is completely durable right now, which actually makes me think about the broader hardware cycle. Usually it's a brutal boom and bust game. You overbuild, then you starve. Does being the asset-light plumber of the cloud soften that eventual bust?
It protects the downside, sure. But if you want a reality check, look at their physical AI comments. Robotics, autonomous warehouses. Destor basically admitted that physical AI is in its very early commercialization stage. He said there is very little real-world deployment and costs remain high.
So the robotic warehouse takeover is delayed.
Barely off the drafting table, meaning their near term is still entirely tethered to hyperscaler data centers. If the big tech giants ever blink on CapEx, Jabil feels it immediately. But for now, nobody is blinking. They're just throwing cash at liquid cooling.
It is actually hilarious when you step back. You hear artificial intelligence and picture a glowing digital brain, but really it's just extremely hot silicon that needs aggressive air conditioning.
Pretty much. The pinnacle of human progress currently depends on advanced HVAC systems.
This is wonderfully bleak, but probably true. Look, if Jabil is basically the physical landlord for the AI build-out, the rent is definitely getting paid this year. We'll just have to see if they actually sign that third giant client by next quarter.
So if you want these breakdowns to just quietly show up on your feed, hitting follow is probably the easiest way to do that. Just a heads up that this podcast is AI generated, which is honestly how we can process these filings so fast right after the bell. For any ticker requests, drop a note to earningsunscripted@datamadness.ca or grab the X link in the show notes. Thanks for sitting in with us today. See you next time.
Catch you on the next one.